Stop watching the numbers on your screen. Because right now, as you read this, two prices exist for the same metal. In New York, silver trades at $74. In Shanghai, the same silver, $100, but a $25 gap between the same asset, on the same planet, in the same moment. This is not a spread. This is not volatility. This is a fracture in the global pricing system. And when markets break like this, someone always pays the price. The question is, will it be you? Welcome to Financial Revelations. If you've been in business long enough to remember when a handshake meant something, when contracts were honored, when markets actually reflected reality, then you understand why what we're about to discuss matters. This channel exists for those who remember the old rules and need to understand the new game. If that's you, if you've built something, if you've weathered previous storms and intend to weather this one, do something for me. Hit that subscribe button. Not because I asked, but because you recognize that in times like these, reliable information is the difference between preparation and panic. And before we begin, drop a comment below. Tell me where you're watching from. London, New York, Singapore, Mumbai. Because what's happening in silver markets right now, it's not contained by borders, and I want to know how close you are to the epicenter. Now, let's talk about what happens when the global pricing system breaks in half. There's a moment in every market collapse when the numbers stop making sense, when traders stare at their screens and realize the system they trusted has quietly broken in half for silver. That moment is now. On trading floors in New York, screens display $74.59 per ounce. Traders see green candles, they see volume, they see what appears to be a functioning market. But 5,000 miles east, in Shanghai, a completely different reality exists. Physical silver, the actual metal, trades at prices that convert to $100 per ounce. $25 higher for the same asset at the same time. This is not supposed to happen. In functional markets, when prices diverge between locations, arbitrage traders immediately step in. They buy where it is cheap, sell where it is expensive, and the gap closes within hours, sometimes minutes. But this gap has not closed. It has widened, and it has persisted for weeks. Professional traders have a term for this phenomenon. They do not call it a premium. They do not call it a spread. They call it a broken market. Because when a $25 gap exists and refuses to close, it means the fundamental mechanism of price discovery has failed. Something is preventing the normal flow of capital and metal from balancing these two realities. To understand what is happening, one must first understand what these two prices actually represent. The New York price, the $74, is derived from COMEX futures contracts. These are paper instruments, legal promises to deliver silver at a future date. They trade in vast quantities. Hundreds of millions of ounces change hands daily on screens. But here's the critical detail. Less than 1% of these contracts ever result in physical delivery. They are settled in cash. They are rolled forward. They exist primarily as financial instruments for speculation and hedging. The system works as long as everyone believes physical silver is available if they demand it, as long as the promise remains credible. But in Shanghai, there are no promises. There are no paper settlements. There is only metal. Solar panel manufacturers need silver paste to construct photovoltaic cells. They cannot use a futures contract. Electric vehicle producers need silver contacts for battery management systems. They cannot wait for paper settlement. Chinese citizens purchasing bars for wealth preservation. They want atoms, not agreements. This is a physical market. And when millions of buyers compete for a finite supply of actual metal, the price reflects that scarcity. The divergence reveals something profound. The Western financial system has created a pricing mechanism based on infinite liquidity, on the assumption that paper and physical are interchangeable. The Eastern industrial system has created a pricing mechanism based on securing actual supply, on the understanding that production cannot wait. And now, these two systems are looking at each other across a $25 chasm. History provides context for what this means. In 1968, the London gold pool collapsed when central banks could no longer suppress gold prices below $35 per ounce. Physical demand exceeded available supply. The paper price became irrelevant, and the system reset violently. In March 2022, the nickel market on the London Metal Exchange suspended trading when prices spiked 300% in a single session. Short sellers could not deliver physical metal. The exchange canceled trades. Confidence shattered. These were not temporary disruptions. These were structural breaks. Moments when the gap between paper promises and physical reality became impossible to maintain. Silver is now experiencing its own version of this break. But unlike previous episodes, this one involves the world's largest industrial economy on one side and the world's largest financial markets on the other. The scale is unprecedented. The implications are profound. Because every day this gap persists, a question becomes more urgent. Which price is real? The $74 that Western traders see on their screens? Or the $100 that Eastern manufacturers are actually paying? The answer to that question will determine who survives what comes next. And what comes next is the mathematics of arbitrage colliding with the physics of scarcity. When paper markets meet physical reality, only one can win. There are two silver markets operating on this planet right now, and most people have no idea which one they are looking at. Imagine a warehouse. On paper, the inventory sheet says 1 million ounces of silver sit inside. But when someone walks to the vault and asks to withdraw their metal, they discover that same million ounces has been sold to 50 different buyers. Each buyer owns a receipt, a certificate, a legal claim, but there's only one pile of metal. This is not a hypothetical scenario. This is the foundation of how modern commodity exchanges function. In New York, the COMEX operates on a system called fractional allocation. The exchange holds a certain amount of physical silver in its vaults. But the contracts trading on its platform represent multiples of that physical inventory. On an average day, more than 100 million ounces of silver trade hands electronically. Yet the actual registered silver, the metal available for immediate delivery, sits at roughly 30 million ounces, a ratio of more than 3 to 1. Some analysts estimate the true leverage ratio, when accounting for all derivative positions, exceeds 100 to 1. 100 paper claims for every physical ounce. The system survives because most participants never ask for delivery. They settle in cash. They roll contracts forward. They treat silver as a financial instrument, not a physical commodity. But across the Pacific, a fundamentally different architecture exists. The Shanghai Gold Exchange, which also trades silver, operates under strict physical settlement rules. Every contract must be backed by metal in approved vaults. No fractional claims, no cash settlement, no leverage beyond what physically exists. When a Chinese solar manufacturer purchases silver through Shanghai, they receive warehouse receipts for actual metal, not promises, not derivatives, not future obligations, metal that exists, that can be loaded onto trucks, that can enter production lines, and the structural difference creates two completely separate pricing mechanisms. In the West, price is determined by the marginal trader, the speculator willing to take the opposite side of a leveraged bet. Large commercial banks hold massive short positions, betting that silver prices will fall. They can do this because they do not need to own the physical metal. They only need enough capital to maintain margin requirements. As long as most contracts settle in cash, this system functions. But in the East, price is determined by the industrial consumer who needs the metal today, not next month, not in abstract future form. Chinese electric vehicle manufacturers are not speculating. They are securing supply chains. When they bid for silver, they bid with the understanding that production lines stop if metal does not arrive. This is not financial maneuvering. This is operational necessity. The data reveals the scale of this divergence. In the past 18 months, China has imported physical silver at rates not seen in over a decade. Customs data shows consistent monthly inflows exceeding 100 million ounces. Simultaneously, COMEX registered inventories have declined by 40%. The metal is moving from west to east, from financial vaults to industrial stockpiles. Yet the price in New York barely reflects this drain. Why? Because the paper market continues to trade as if supply is infinite. New short positions open daily. Speculators sell contracts they do not own. Market makers provide liquidity by creating synthetic supply. None of this requires actual metal until someone demands delivery, and that is where the system reaches its breaking point. Standing for delivery, the act of demanding physical metal instead of cash settlement, has begun to increase. Small refineries, industrial buyers, even individual investors are asking for the actual product, and the exchange is struggling to fulfill these requests. Delivery delays have stretched from days to weeks. Premiums for immediate physical delivery have spiked. The warehouse receipts that once moved seamlessly now face verification challenges. This is how fractional systems collapse, not in a single dramatic moment, but through a gradual recognition among more and more participants that the promises exceed the assets. In China, this realization has already occurred. Industrial planners learned during the pandemic that global supply chains are fragile. That dependence on Western financial markets for critical materials creates strategic vulnerability. So they pay premiums, they stockpile aggressively, they prioritize physical possession over paper savings. This is rational behavior in a world where production capacity matters more than financial optimization. But in the West, the old assumptions persist. Fund managers still treat silver as just another line on a portfolio allocation spreadsheet. Banks still maintain short positions backed by models that assume infinite liquidity, Regulators still believe that paper markets accurately reflect physical availability. They are operating with maps drawn for a world that no longer exists, because the architecture has changed. The East has built a fortress of physical metal. The West has built a tower of paper claims, and the $25 gap between them is the distance between these two realities. One is anchored in atoms, the other floats on promises. And in every market, in every era, in every asset class, eventually, atoms win. There's a law in finance that functions like gravity. When the same asset trades at different prices in different locations, capital flows to exploit the difference. Traders call it arbitrage, economists call it price convergence. But what is happening in silver right now is neither. This is something far more violent. This is a vacuum. And it is pulling metal out of the West at a speed that most market participants have not yet comprehended. Consider the mathematics. A trader purchases 1,000 ounces of silver in New York at $74 per ounce. Total cost, $74,000. They arrange shipment to Shanghai, $3 per ounce for insurance, logistics, and customs. They sell the metal in China at the equivalent of $100 per ounce. Total revenue, $100,000. Subtract costs, subtract financing charges, subtract currency hedging. Net profit, roughly $20 per ounce, $20,000 on a single shipment. This is not a narrow margin that requires sophisticated infrastructure. This is a profit so massive that even small operators can participate. And they are. Shipping manifests from major refining hubs tell the story. Silver leaving Switzerland, silver leaving the United Kingdom, silver leaving Canada, all moving east. In previous years, these flows balanced. Metal moved in both directions based on seasonal demand and regional premiums. But over the past 6 months, the flow has become unidirectional. A river that only runs one way, from paper markets to physical markets, from financial centers to manufacturing hubs, from promises to possession. The COMEX vaults reveal the damage. Registered silver, the category available for immediate delivery, has dropped below 30 million ounces. 3 years ago, that number exceeded 90 million, a decline of more than 60%. But here's the critical detail that most observers miss. Daily trading volume on COMEX still exceeds 100 million ounces, which means the entire available physical inventory turns over every single day on paper. The leverage has not decreased. It has increased. As physical metal drains away, the paper market has become more, not less, detached from reality. Why does this happen? Because the incentive structure rewards short-term liquidity provision over long-term physical responsibility. Market makers earn profits by facilitating trades, not by ensuring delivery capacity. Commercial banks generate fees by writing derivative contracts, not by stockpiling metal. The system is optimized for transaction volume, not settlement integrity. And as long as most participants accept cash settlement, the illusion holds. But physical demand is rising. Industrial consumers who once trusted just-in-time delivery now demand inventory buffers. Refineries that once operated on thin margins now face penalties for delivery failures. Even individual investors, watching premiums spike, are demanding possession over paper claims. Each delivery request removes metal from the exchange system permanently, because once silver leaves the vault and enters private storage or industrial use, it does not return to COMEX. It enters a different ecosystem, one where metal is valued for what it does, not what it represents. But the arbitrage flow creates a feedback loop. Physical drain increases scarcity in Western vaults. Scarcity should increase prices, but paper short selling suppresses price increases. Suppressed prices create even larger arbitrage opportunities, which accelerates physical drain, which increases scarcity further. This is not a stable equilibrium. This is a death spiral for the paper market. Yet it continues, because the players executing this arbitrage are not small speculators. They are large institutional trading houses, international bullion banks, sovereign wealth entities, organizations with the capital to move metal by the ton, not the ounce. They understand something critical. This gap will close. Either New York prices rise to meet Shanghai, or Shanghai premiums collapse back to New York. But the probability is not equal. Shanghai's premium is driven by real industrial demand, by strategic stockpiling, by physical scarcity in the world's largest manufacturing economy. New York's price is maintained by paper contracts, by speculative positioning, by assumptions of infinite supply. One is anchored in necessity, the other floats on belief. And when belief meets necessity, necessity wins. So the smart money is not betting on convergence. They are forcing it. Every ton shipped east removes supply from the west. Every ounce that leaves COMEX vaults tightens the noose on short positions. Every delivery demand tests whether the promises can be kept. This is not passive arbitrage. This is active draining, deliberate, calculated, relentless. The vault data shows no sign of reversal. The shipping manifests show no sign of balance. The price gap shows no sign of closing. Because the entities executing this trade are not looking for a quick profit, they are repositioning for a world where physical possession matters more than financial claims, where supply chains are measured in tons held, not contracts owned, where the word delivery is not a technicality, but a strategic imperative. The West built a market on leverage and liquidity. The East is dismantling it, one shipment at a time, and every ounce that crosses the Pacific is a vote of no confidence in the paper system. The question is not whether this vacuum will empty the vaults. The question is what happens when there's nothing left to drain, when the promises outnumber the atoms by so much that belief itself collapses. That moment is approaching faster than the market makers realize, because gravity always wins. And right now, gravity is pulling east. Every broken market reaches a moment of reckoning, a point where the gap between paper and reality becomes impossible to maintain, where the mathematics of scarcity overpower the illusions of liquidity. Silver has reached that threshold, and what happens next will determine more than just the price of one metal. It will establish the rules for how physical commodities are valued in a world where East and West no longer agree on what constitutes a market. There are three paths forward. Only one is probable. The first scenario, the one Western financial institutions are quietly hoping for. Chinese demand saturates. Industrial consumption peaks. Stockpiling goals are met. Government policy shifts. The physical premium in Shanghai collapses back toward Western paper prices. The gap closes from the East. Arbitrage flows reverse. Metal returns to COMEX vaults. The fractional reserve system stabilizes. Market makers breathe easier. Short positions survive. The paper market maintains credibility. This is the soft landing. But the data suggests otherwise. Chinese solar panel production is not slowing. It is accelerating. Electric vehicle manufacturing is not plateauing. It is expanding into Southeast Asia and Latin America. Strategic stockpiling by Chinese state entities shows no signs of completion. Every indicator points towards sustained, perhaps increasing, physical demand. This scenario requires a reversal of industrial trends that show no evidence of reversing. It requires China to stop behaving like a nation, securing critical supply chains. It requires belief that the largest manufacturing economy will suddenly prioritize financial market stability over resource security. History suggests nations do not make that choice. The second scenario, the one no one is publicly discussing, permanent bifurcation, two separate pricing systems operating indefinitely with no convergence. The West continues trading paper silver at $74. The East continues trading physical silver at $100. Capital controls prevent arbitrage. Regulatory barriers block metal flows. The markets decouple completely. This is the controlled fracture. It preserves the paper system by isolating it from physical reality, but it destroys the concept of a global price, of a unified commodity market, of trust in financial benchmarks. Mining companies face an impossible question. Which price do they use for long-term contracts? Industrial consumers outside China face supply insecurity because physical metal flows to whoever pays the physical price. The derivative market loses legitimacy because it no longer reflects the cost of actual production inputs. This scenario is possible, but unstable, because arbitrage opportunities do not disappear simply because governments wish them away. Capital finds ways around barriers. Metal moves through gray channels. Premiums leak across borders. Maintaining separation requires constant enforcement, escalating controls, economic inefficiency that compounds over time. And it still does not solve the fundamental problem. The West is running out of metal, which brings us to the third scenario, the one that data is screaming toward. Western prices rise to meet Eastern reality. The paper market capitulates to physical scarcity. COMEX silver spikes toward $100 per ounce, possibly beyond. This is not a prediction based on hope or speculation. This is mathematical inevitability once certain thresholds are crossed. When registered COMEX inventories fall below 20 million ounces, delivery requests will exceed available supply. When short positions cannot be covered without purchasing physical metal, forced liquidation begins. When industrial consumers in the West realize their supply chains depend on a market structure that is failing, panic buying accelerates. Each of these triggers creates a cascading effect. Rising prices force short covering, which removes more metal from circulation, which drives prices higher, which triggers more forced buying. The speed of convergence in this scenario is not gradual. It is explosive, because markets that break do not heal slowly. They reset violently. The timeline depends on specific threshold events. If COMEX registered inventories drop below 15 million ounces, institutional confidence cracks. If a major commercial bank fails to deliver on a large contract, counterparty risk becomes systemic. If Chinese purchases accelerate beyond current rates, the drain reaches critical velocity. Any of these could occur within months, not years. For those positioned incorrectly, the consequences are severe. Industrial manufacturers who relied on paper prices for procurement planning will face input cost shocks. Financial institutions holding large short positions will experience losses that threaten solvency. Investors who assumed COMEX prices reflected reality will discover their benchmark was fiction. But for those who recognized the fracture early, who understood that physical possession outweighs paper promises, who moved capital toward actual assets rather than derivative claims, this reset creates generational wealth transfer, not through speculation, but through preparation. The lesson of this moment extends beyond silver. This is a case study in what happens when financial engineering diverges too far from physical constraints, when leverage exceeds prudence, when promises exceed assets, when belief systems collide with material reality. The outcome is always the same. Physics wins. Atoms matter more than agreements. Scarcity trumps liquidity. The silver market is teaching this lesson in real time. A $25 gap is not a trading opportunity. It is a warning that the financial architecture built over decades, optimized for transaction speed and leverage, is colliding with a new reality, where the world's largest manufacturing economy refuses to accept paper as a substitute for metal, where supply chains are strategic assets, not financial abstractions, where possession is not 9/10 of the law, it is the entire law. The Western paper market can continue trading at $74, but it cannot change the fact that physical silver is being valued at $100 by the entities that actually use it, and in the end, the users set the price, not the speculators, not the market makers, not the exchange operators, the ones who need the metal to build the products, to power the industries, to secure the future. They decide what it is worth, and they have decided. The only question remaining is how long the paper market can pretend otherwise, and what breaks when pretending becomes impossible.